Welcome to Money on Your Mind. My name is Belinda Fuchs, the host of Money on Your Mind, and a wealth coach, CPA, and president of OwnYourMoney.com. At OwnYourMoney.com, we help people through their emotional blocks to money to then help them make more, save more, and stress less about the money on their mind. I think of myself like a cross between a financial therapist and a business coach. We understand that money is on your mind nowadays, and we want to help you thrive, not just survive, in today's turbulent times. So, if you have mortgages on your mind, you want to absolutely stay tuned to our show today. Our topic is making sense of the mortgage industry, and I have two very experienced guests here to help you make sense of everything that's going on right now. So with us today, we have Rich Vernet, who's Vice President of Mortgage Originations at Winter Hill Bank, and has worked as a mortgage officer for 16 years. Before Winter Hill, Rich worked at Boston Federal Savings Bank and Salem 5 Bank and served as an officer in the Air Force for 10 years. Also with us is Amy Slotnick. Amy is Director of Strategic Development at Fairway Independent Mortgage and has worked in the mortgage industry for 25 years. She began her career in the mortgage industry in 1983 as an underwriter. Since that time, she has gained experience in every facet of the mortgage business, including operations, sales, management, and ownership. Today, she is proud to be among the few loan officers who has a designation of CMPS. As a certified mortgage planning specialist, Amy is trained to analyze her clients' mortgage needs as part of their total financial planning strategy. So welcome. It is such a pleasure to have you both here today.
Thank you.
Thank you. And what I felt like would be a great place to start to help people really make sense of everything going on in this mortgage environment is to just start with a basic education in terms of how do we think of fixed mortgages, adjustable rate mortgages, points, closing costs. So, some of the terms that we hear in the paper, but we might just not really know what they mean. So Amy, do you want to start?
Sure, I'd be happy to, Belinda.
Great, thanks.
In the market right now, there are basically two types of mortgages available. As you mentioned, the fixed rate and the adjustable rate. The fixed rate is just that. The rate is fixed from the start of your mortgage until the end of your mortgage. And the most popular fixed rate loans have a 15 or 30-year term. There are other options available in typically 5-year increments, but 15 and 30 tend to be the most popular. Adjustable rate mortgages have both a fixed and an adjustable component. For example, a 5-year adjustable rate is fixed for the first 5 years. They are 30-year terms, so for the next 25 years on an annual basis, they adjust. All adjustable rate mortgages, have caps that restrict how much they can go up in any year and over the life of the loan as well. And they have a mathematical calculation that determines what your rate will go to each year.
Great. And then they're usually adjusting based on some rate in the market.
Right. It's typically either the 1-year Treasury bill or the LIBOR, and plus some margin that is fixed for the life of your loan.
Excellent, thank you. And I appreciate your explanation because I think that sometimes it's a little bit confusing because people think, oh, I have a fixed mortgage, but it's really only fixed for the initial 3 years or 5 years because it's really an adjustable rate mortgage. So thank you for that. Rich, can you continue and maybe explain points, closing costs, some of the other terms we hear?
Right. Well, talking about the, just getting back to the ARM, we brought up that like in a 5-1 ARM right now, if your 5 years was up today, let's say your rate was at 5 1/4, at least at Winter Hill Bank, you would be adjusting down below 4% because the 1-year Treasury index is the index that we use, and we use a margin of 2.75. And the 1-year Treasury index, I think, is about 0.6. So today, when you hear that someone their adjustable rate is rising, they either have some sort of funky mortgage product that they got into originally, but on a normal, like at a Winter Hill Bank, your rate would actually be going down. So, and what was your question was about closing costs?
Can you explain points and closing costs a little bit for us?
Points are simply a percentage of what you're borrowing. So let's say that someone says, well, I'm paying 1 point on a $300,000 loan. That would be 1%. It's just a percent. So it'd be 1% of 300 would be $3,000 in it. And points are you pay points to lower the rate over the life of the loan.
Right. So, and 1 point normally gets what as a
usually between 1/4 and 3/8% on a rate. So like a current rate today in a 30-year fixed is somewhere around 5% with no points.
Mm-hmm.
And so if you paid 1 point, you might get down to 5 1/8 or 5 1/4%.
You mean?
Or 4 and an eighth, actually.
Oh, I'm sorry. Yeah,
Right. If we're at 5, we're going to go down maybe to 4.5 or 4.
Wouldn't be that much with 1 point. You'd go down about 3/8. So my calculation was right, 5.5.
I think you had said 5 at no points as your base rate, and I think that's
then I went the opposite. I'm sorry.
That's okay.
Right. It would be the other way around.
It's funny because we're having this conversation, right, and we even have to double think it sometimes.
Right.
Because sometimes it's just not so intuitive what the impact is going to be when you make some of these choices.
And I think historically it's been, just for ease, 0.25%. So if the rate's 5.25% or 5% with 0 points, then you would go to 5 or 4.75 with 1 point.
Right.
And each point will continue to buy your rate down.
Right.
And then you have to look at the math. As a consumer, you have to say, when I look at the lower rate having to pay fees versus fees being points versus the higher rate without points.
Right.
Where is my break even? How long will I own this home? How long will I keep the mortgage? The average life of a mortgage these days, Belinda, because of sales of homes or because of refinancing, is only between 4 and 7 years. So when you look at the break even about what you want to do with your money, do you want to spend it to reduce your rate, or do you want to spend it to put furniture in your home or to buy a new refrigerator? So sort of what's the utility of your money versus what your monthly payments will be?
Right, so it's really thinking what's the cost benefit of the choice I'm making today based on my expectation of how long I'm going to stay in my house. And I think what's happening right now is that people are maybe staying in their homes a little bit longer than they did because they may not feel like they can sell right now. You know, these are certainly going through people's minds. I've also heard that historically closing costs had often been covered by the loan itself, but now with what's happening with the rates going down, that sometimes closing costs or appraisal costs may have to be picked up by the buyer more than they have before.
Right.
Do you find that in your work?
Was standardly offered what is called premium pricing, so that at higher interest rates, the lenders would earn more money and they would use that excess money to pay your closing costs for you. Let's be very clear with your viewers. There is no such thing as no closing costs. There are closing costs on every loan. It's just where are they paid and by whom?
Who's absorbing them?
Who is absorbing them? So sort of in the past, over the past several years, the closing costs have been able to be absorbed by the lender by charging you a higher rate for not having any. Because of the way the markets are right now and the pricing, it is harder for us to earn more premium, and therefore the buyers are typically choosing 0 points but paying their own closing costs.
That's correct.
Or they're putting them into the loan amount instead of into the rate.
Right, and for something like points, do they have to pay them up front though? Can they put those in the loan too?
Oh, yeah, if you're refinancing, you certainly could, along with the closing costs.
Right, and then
As long as you have enough equity.
As long as you have enough equity, right. The $1 million
right
question,
now,
right?
right.
And then in terms of the amount of closing costs, just for people to have some idea of what's reasonable, what do you find on average?
Well, I think that there's a difference between different institutions, and that's something that someone has to look at when they're judging.
A range, maybe $2,000 to $3,000.
Probably $2,000
Yeah,
to $3,000 is fair.
Right.
That's kind of what I figured.
Yeah, like in a $300,000 loan at Winter Hill, you'd be somewhere around $2,500.
Okay, so we have the range,
That's
at least for
fairly
people.
standard.
So if it were more than that, you have to ask the questions.
Right, and someone should ask the questions what those fees are. Ask for what's called a good faith estimate, which is what breaks down each fee. And the lender is required by law to provide that to you. You're not imposing upon the lender by asking them to give that to you. And the good faith estimate will break down each fee. And when you're looking at it, if there are fees that sound like you can't identify them and where they're going or to whom, then you need to question them.
Right, got it. Okay, that makes a lot of sense. Thank you. So we started to just touch briefly on, we laughed, but it's a little bit of a nervous laugh about the challenges that people are facing right now in the housing market, where their equity has gone down because now the appraised value is lower as it compares to their loan value. So can you talk some about how, what's happening right now in the market, what's causing some of what we're seeing, not really necessarily in the housing market, we can have realtors on another time, but really how is it affecting the mortgage industry, and perhaps how can it benefit or hurt our viewers right now?